was starting to recover a couple of months ago after yesterday, today, whatever. It's going to take a while, but I think we're going to see mood to start to recover. We're working through the financial issues. Working through means there is a program underway to stop some of the foreclosures, get people refinanced, take those foreclosures off the market. If those foreclosures come off the market, there's less price pressure. There's certainly a move to assure that everybody gets their money, so to speak, on some of these bonds. Some people have different opinions about that, but at least given what's going on, the financial system will have lots of money to lend. The economy is slowing. I said uncertainties. I wondered how many of my slides I'd need to revise. I think the word uncertainties doesn't need to be revised right now, but I think we know where we're headed. We're working our way out of a financial panic. And I think we're much closer to the end than you would think. Looking at the economy overall for the future, there are three things that can drive the economy. Housing is one of them. Retail sales and car sales. So there's a lot of other stuff that's very important, but if you follow those three things, car sales, they're a little weak right now, a lot weak. So this suggests that for the foreseeable future, the economy is going to be a little weak. Retail sales, who knows whether it's going to be the worst Christmas ever. That's what Yahoo would like us to say. I mean, you wouldn't sell any papers if you said it's an average Christmas, so we'll say it's the worst Christmas ever. That remains to be seen. Housing starts, they're very low right now. So looking out to the future, the things that are driving the economy right now are weak. And so there's every reason to think that we may be approaching a recession. That's what most economists are suggesting. I'm not at all convinced that we will, but it's certainly starting to look like we're getting there. If we do, that'll be a temporary slowdown. We don't expect it to be real long. Mood, people call consumers up every month and say, how do you feel? Well, what do you think they're going to say this month? Lousy. But they've been feeling lousy for quite a while, off and on. Got a little problems. Financial issues. Here is the heart of where we caught fire, or at least where the gunpowder was when we caught fire. If you could see that, which you might not be able to, you can see that for a couple of years we went well over $1 trillion on subprime mortgages. That's the problem, because a lot of these people, I'm sorry to tell you, aren't going to pay. They haven't paid. They don't have the money to pay. As I like to say, if it's an AGH, it ain't going to happen. They just don't. They're just not paying. That's the origin of this $700 billion bailout. I'd like to tell you it's solved. Yeah. Well, it isn't. Unfortunately, I suspect, and the data are weak in this, I suspect that the last 2 years of subprime lending haven't yet shown up in the numbers. And if that be the case, because after all, a mortgage doesn't go bad the first year it's made. It takes a while for those interest rates to reset. It takes a while for that mortgage to come due in some form. It doesn't, you don't file for a bankruptcy or file for whatever you file for the month after you get the mortgage. It takes some months before the mortgage goes bad. So I'm assuming that probably we may have as much as 1.5 to 2 years of mortgages still waiting to work their way through the system. And if that's the case, that number could rise a bit. However, I think we've seen the end. That's all there is. So I think in terms of it getting worse beyond what we know, it's very unlikely. So looking out to the future, prime mortgages are not defaulting in any great numbers. Subprime has been the problem. We may have a few more financial issues. Well, isn't it good, I guess, that we've got the Fed with the checkbook open, because seems to be one way in which it will be solved. Now, there are a lot of people who can point out disadvantages to all this, and I'm aware of those disadvantages, and I don't necessarily disagree with people who say there are some disadvantages. It's just that this is the way it's being done. So I think we'll see the issue resolved. Take a look at this. Only 9% of the mortgages are subprime. mortgages out there are prime, and there's a significant number of houses that are free and clear. But of those, the subprime have accounted for 53% of this problem. So the problem has not been in the prime mortgage area. It's been in the subprime mortgage area. Fortunately, we see at least where it will end. The big question is whether it will end without costing us additional money. Unfortunately, that additional money that it will cost us actually seems relatively small relative to some of these other numbers, but that's the problem. Foreclosure rates. Well, even subprime fixed rates have had a relatively low foreclosure rate. They're at 4%, which is certainly much higher than a prime, which has been approaching 2% now. On the other hand, take a look at those subprime arms. Now, I should have revised this slide, but I said, why? If I had, it would have gone slightly higher on subprime arms. It's bad enough as it is to give you the idea of where we are. That's the major issue. And as I say, we are working through this issue, but that's been the problem. Foreclosure rate comparisons. Well, you can see why things are good here in Idaho. You fortunately are not exposed. I don't know if you can see this at all, actually, but this is Idaho right here. And here's the national average over here. So as you can see, Idaho's in reasonably good shape, which is why things are pretty good shape. So financial outlook, I'm still thinking there may be some additional write-downs. We haven't heard yet, unfortunately, from the hedge funds. I suspect that we will in the next few days as the government addresses that. That's an unregulated part of the economy. If there's a run on the hedge funds, again, there'll be some issues. So I think the Fed, the Treasury, and the President, and all the folks down there in Washington realize the need to watch this. Here again, I have realized there are a lot of different opinions about how this should be done. I'm not necessarily they're doing the best job, but they are addressing the issue. FDIC, where will we head? I say government agencies involved. Well, until a few days ago, the Federal Reserve, the FDIC, the Federal Housing Finance Agency, which regulates Fannie and Freddie, among others, the Office of the Comptroller of the Currency, which regulates a bunch of state banks as well as a bunch of other parts of the banking system, regulated the regulated parts of the system. They didn't regulate Bear Stearns. They didn't regulate hedge funds. They didn't regulate commercial paper. They didn't regulate the $62 trillion of derivatives that are out there. Lots of stuff they didn't regulate. As a result, there was no financial backup. As a result, there's been panic in the streets. Now the government has at least stepped in with the money. Well, obviously, if the government steps in with the money, they're going to step in with the regulations. Because you can't be guaranteeing $3 trillion worth of money market funds without having some sort of regulation. It just isn't going to happen. So I suspect we will have both a contentious and a vigorous debate, possibly quite heated, with people telling each other that they don't like what they're suggesting. And I don't offer any particular insight on how that should come out other than to say something will need to be done to prevent future financial panics. But it's going to be a hot one. But at the end of this, we will see the entire financial system regulated, just not the banks. Because it's clear that's where we're headed. In the meantime, we've got tighter credit standards. Obviously, 0 down was a bad down payment.